To understand what continues to happen today, let's look at the more distant past. One of the most famous bubbles in history is the Dutch tulip bulb craze of the early 17th century. The tulip craze reflects simple idiocy coupled with the stupidity of crowd mentality. Though most of us identify tulips with Holland, they were not indigenous to that country. Originally, tulips came to Holland from Turkey in 1593, imported as a luxury good. However, given their new environment, many bulbs succumbed to a disease, a color-breaking virus that is transferred by feeding insects. It causes the petal pigmentation to break into flame-like multicolored stripes. The Dutch prized these patterns. Since tulip bulbs are perennials, the bulbs preserved their uniqueness and perceived value due to a scarcity of the patterns that were the most prized. As with any rare product of fixed supply, increased demand caused a rise in the market price. Bulb merchants stockpiled the most popular patterns and held them back from the market artificially.
In effect, the phenomenon of tulip mania resulted from hoarding, which led to an escalation in prices. To invest in bulbs, Dutch citizens liquidated good stores of value. Purchasing frenzy caused bulb prices to reach astronomical levels. As market demand outran investment capital, speculators developed call options. These required only a down payment of the purchase price. In January of 1637, margin buying spurred bulb prices to rise 20-fold. However, the bubble burst. During the following month, prices plummeted 20-fold. As the market tumbled, the market equity positions of investors evaporated. Panic ensued. Investment funds fell into bankruptcy as they failed to honor their call options.
Faced with a collapsing financial market, the Dutch government intervened and attempted to settle contracts at 10% of their purchase price. Unfortunately, market prices continued to fall, dropping below the government price floor until tulip bulb prices settled to that of a common onion. The tulip bulb craze mimicked the behavior of other bubbles that have occurred to the present day. First, market speculation built slowly with a gradual ascent in prices. Second, the number of investors increased and that fueled progressive speculation. Third, speculators introduced margin buying, and that helped the market to grow exponentially. Fourth, as the bubble developed, the market rose rapidly to spiked prices. And fifth, that bubble burst and market prices collapsed rapidly due to a contemporaneous failure to meet margin calls.